Crude oil prices ended last week with notable gains, fueled by tightening supplies and strong seasonal demand. U.S. sanctions targeting Russian oil producers and tankers disrupted global shipping routes, curtailing supply and boosting market sentiment. Additionally, colder than anticipated weather in both the U.S. and Europe drove higher heating oil demand, reinforcing the market's bullish momentum. However, mixed demand signals from major economies like China moderated the rally, leaving traders closely watching upcoming data for clearer market direction. Technically, the trend remains bullish, with the market surging since breaking above the retracement level at $70. The next major hurdle lies at the July high of $82, which could pave the way for a move toward another multi-month peak at $86. However, my base case scenario at the moment is that if prices break through the $77 support, they could dip toward the $75 level, where we are likely to see renewed buying interest. Natural gas futures experienced a volatile week, surging to a multi-month high of $4.35 before reversing sharply to settle lower at $3.95. Natural gas prices surged early in the week, fueled by forecasts of an Arctic blast expected to plunge temperatures to -20 degrees Fahrenheit to 20 degrees Fahrenheit across critical regions like the Midwest and Texas. The severe cold drove expectations of increased heating demand, pushing prices to a multi-month high. However, midweek updates from US and European weather models introduced a milder outlook, predicting fewer heating degree days. This shift prompted traders to take profits, sparking a sell-off that halted the market's bullish momentum. The Energy Information Administration reported a significant 258 billion cubic feet storage withdrawal, nearly double the 5-year average of 128 billion, underscoring the impact of cold weather on residential and commercial heating demand. Despite this substantial draw, U.S. storage levels remain 77 billion cubic feet above the 5-year average, offering a cushion against sharp price spikes. This surplus, coupled with forecasts for milder weather, has dampened bullish sentiment. Adding to the downward pressure are seasonal declines in power generation demand and indications of softening LNG flows. The weekly closing price reversal top at $4.35 serves as a notable bearish technical signal, often suggesting a move toward lower prices. This pattern underscores the market's failure to maintain its rally after reaching a multi-month high. The subsequent sell-off was amplified by profit-taking and diminishing weather-driven demand, illustrating how quickly market sentiment can pivot when technical indicators align with shifting fundamentals. In case nat gas manages to settle below the support at $3.80, it will move towards the next support zone in the $3.60 to $3.40 range. Moreover, continued selling pressure could drive prices toward the near-term retracement zone of $3.20 to $3. However, a resurgence of Arctic cold or a surge in LNG demand could quickly revive bullish interest. Please like, subscribe, and comment to support the channel. See you in the next one.